Welcome to this edition of the Capital Brief. I'm Seth Berenzweig here in our BL Media Studios in beautiful downtown Tysons, here with our friend and colleague John Tamny from RealClearMarkets. John, how are you?
I'm great. Good to be back.
Yeah. So we're both perhaps suffering from a little bit of jet lag. You just flew in from the West Coast in California. What were you doing in California?
Forbes University. So, yeah.
Wow, very cool. I just flew back from the EU. Had a vacation in Germany and Austria. And the only thing that I will say is the two things that was really amazing to me about the EU, among many others, is that the people were incredibly friendly, and the infrastructure in the EU is so much better than ours. The trains, for example, are so much better, and to think that a fast Amtrak can go 80 miles an hour as opposed to 280 miles an hour. Well, that'll be a whole other topic for another.
I like it.
Yeah. Anyway, what we're talking about today is the question of whether the Fed is or is not behind the market rally. We know that the market's been pretty volatile. It's up, it's down, it's all around, but for over a decade, we've basically had a nice rally in the market. After we had a lot of toxicity in the market with collateralized mortgage obligations and a lot of emergencies, the market has been on a bull run. And it's been on a bull run, generally speaking, for over a decade. There was a very fascinating article that you published recently that was questioning the theory of something that I've heard at a lot of dinners and cocktail parties. And it reminded me of a time not long ago where I was having drinks with a good friend, and he was talking, we're trying to swap ideas about the market, and we're all trying to make money. And he said, there's one thing I know. He said, you can't fight the Fed. And he said it with this reverent air of just treating it as something that is so true. John, tell us about your recent article and how it relates to that proposition. Is the Fed behind the market rally? And stated more generally, can the Fed or does the Fed have any influence on a market rally?
No. If the Fed were behind the stock market rally, then there would not be any market to invest in because it would be so devastated by just that. And probably the place to begin, and there's so many ways to look at this, but let's just travel to see why this argument is absurd. Let's travel back to the beginning of the 21st century. What was the most valuable company in the world at the time? It was GE. What was the company crowned by barons on the cover as the next GE? Tyco. What was the best managed corporation in the world with the smartest people? It was Enron. What was the most advanced communications company? Lucent. The internet was suddenly a very prominent player in U.S. technology and the economy. What were the two dominant firms at the time? AOL and Yahoo. Have you heard much of those companies today? And the answer to that question explains why the Fed couldn't be behind a rally. If the Fed could, we would be suffering the kind of stasis economically that has always destroyed economies and, by extension, stock markets.
One of the areas that I went on my trip to Germany was Berlin, and there was such a striking difference between the former East Berlin and West Berlin. And the reason that I think this is relevant is that in your article, you're talking about the historic impact of central government control. And the thing that's so fascinating, having just got back from Berlin, is to see how the free market economy gave West Berlin a 50-year head start. And when you walk through the city and you see such vivid differences and these relics of Checkpoint Charlie and the Berlin Wall and things that now are really just areas where tourists take selfies, the theory that the government, through central planning, actually has any kind of efficiency or control in and of itself is such a very fascinating theory. But you of course, take the analysis a lot further, and you go into more granular depth in talking about these examples. In your article, you talk about Barron's, and I find that really interesting because I noticed online today that there was a quick interview with Jeff Bezos, and Jeff Bezos shared a Barron's article today. That was, and maybe you're laughing because you might know what I'm talking about, where he showed a 22-year-old article from Barron's. And it predicted that Amazon was going to just poop out, and it was going to do nothing. I just wrote this down in my notes. It called Amazon, quote, just another middleman. Said that it was going to lead to nothing, and that it was just fat and fluff, and that it was just going to wither away. Today, it's worth well over $1.5 trillion. So, maybe the so-called masters aren't so masterful after all. But I read that right after I read your article, and it was like, well, I guess someone's going to. You and Jeff Bezos probably have, some fun things to talk about. But looking at your theory, one of the things that I thought back on that I've wanted to ask you is, I agree with a lot of what you're saying in the article, but what about how would you then counter the point that markets do have short-term fluctuations and sometimes dramatic moves as a direct result of actions taken by the Fed? The Fed minutes, fluctuations in interest rates. There are times where the market might swoon or might take different actions in the short term based upon announcements from the Fed. I agree with the basic tenor of what you're saying, but how would you characterize what that dynamic is? Is that just an excuse for the market to just pull back? Is there any kind of a connection there, even if it's a correct or an incorrect correlation?
I think we overstated. I think there's a lot more coincidence to the Fed minutes said this and the markets rallied or the markets tanked. Just to give an obvious example, if you go back to 1998 and the Asia crisis at the time. So I was a new associate at Goldman, and they talked about how when Alan Greenspan announced a 50 basis point cut that suddenly the screens went green, that suddenly the calls to the desk, oh my gosh.
Right.
Okay, but then look at March of 2020. The Fed went to zero on March 12th or 13th of 2020, and stocks collapsed the next day.
Right.
Can't fight the Fed? Well, if you had bought into that, you would have bought stocks in 2000 and 2001, and you would have wiped out because, see, the Fed was cutting rates massively then. The Fed started cutting rates enormously starting in 2007.
Right.
If you'd said, oh, well, got to go with what the Fed's doing. Conversely, if you'd said, well, see, the Fed rate cutting is good for stocks, rate hiking's bad for stocks, you would have sold off in 2015 when the Fed started aggressively raising rates just about every. And so I think it's a lot more coincidental than anything. And certainly in the longer term, looking at this, the simple truth is markets gain strength from the periods of weakness because that's what pushes out the bad. And the Barron's example is crucial here. Mm-hmm. In the year 2000, Amazon was Amazon.org. Couldn't make a profit. Peddling books and CDs and DVDs, it's never going to make it. It's all the optimism's priced in. This internet's faddish. Apple was just emerging from near bankruptcy, and no one really wanted to touch that. How we know that is how much you would have made if you'd purchased Apple in 2000. Luckily, Bill Gates saved it. Well, what about Bill Gates? Well, Microsoft had just been basically suffocated by the Department of Justice and was on the verge of 10 to 13 years of flat stock price. Google was unknown, but even by 2006, it was neck and neck with MySpace in terms of daily visits. Heard of MySpace lately? Which brings us to Facebook. Well, Facebook didn't exist because Mark Zuckerberg was in boarding school at the time. Those are now the 5 most valuable companies in the world. But per that Barron's article from 22 years ago, who would have done that? And so implicit in this, well, the Fed did it, is that the Fed not only knows how to put out to pasture the GEs and the Tycos, but it knows how to direct precious investment power to companies that no one would have predicted 22 years ago. Right. The very notion defies basic common sense, but it defies the bigger truth that we gain strength from the past being put in the past and the future basically pushing the past out to pasture.
What you're doing is you're also highlighting instructively the importance of, as a potential investor or a current market investor, the critical importance of looking at the right data. And making sure that as an investor that we don't accept absolutes, that we don't accept these, don't take any wooden nickel sort of, pieces of advice. Don't fight the Fed, or there are just so many of those out there. But the thing that's really interesting to me is that there's so much noise. But there's also so much really helpful data out there that people don't pay attention to. A lot of the noise and a lot of the disruption comes from Washington. Your article did a great job identifying how the Fed contributes to that. Obviously, I think Capitol Hill contributes to it too, because there's a lot of conversation about some legislation that might even perhaps have a positive impact. But yet it just is just a bunch of jammering and happy talk, and it doesn't even lead anywhere. There are concerns in big tech about certain kinds of misinformation that could lead to financial fraud or physical violence. In very limited instances, Congress has been talking about having a light touch piece of regulation on how to be able to manage that part of the market. They haven't even been able to pass any kind of that legislation. So even when in a small or light instance that Congress can actually try to do something that in a very particular instance might be helpful, they can't get it accomplished anyway. I mean, how long has Congress been talking about the infrastructure bill? Who knows if that's ever going to pass? So, I found that aspect of the article interesting, and also in terms of a lot of other noise out there. What are other distractions that you see people getting pulled into a direction that's keeping them away from making the right kinds of investment decisions?
Well, I think the distractions are in assuming that there's something mechanical to the stock market, that if an entity like the Fed does this, well, something here happens. And so an obvious example of this, they say, well, oh, no, John, see, you're not an economist. You don't understand. See, the Fed, in fiddling around with doing QE, it told investors to pile into stocks, that it would back them. Oh, really? Well, so what happened in Japan? Because there have been 11 QEs since the late 90s with the Nikkei still half of what it was in 1989. Why isn't Europe rallied like this? Why is it this is unique to the United States? Was Ben Bernanke and Janet Yellen, were they particularly smart? They said, well, no, but see, you don't understand. See, the Fed is pushing down long rates of interest. And because yields on treasuries are going down, they're
trying to encourage people
to rush for yield.
Yeah.
Oh, wow, that's really intriguing. Except for if that were true, we would have seen a great rotation as in a sell-off in bonds over the last 11 years. But if you look in 2009 when this rally began, the 10-year Treasury note at the time was yielding about 3.6%. Now it's 1.5%. And so every argument they make, these distractions that they look for, everyone's looking for an easy answer to something that's incredibly complicated, that's a consequence of global cooperation. And so every time you look at the explanations, you think that is so easy to discredit. Yet watch CNBC on a daily basis, and all of these falsehoods are just accepted as truth.
Absolutely. And a lot of the coverage on CNBC, and believe me, a lot of it, there are some journalists and some things that I watch on many of the channels, including CNBC, that I admire. But a lot of it is also very superficial, and there obviously is a lot of noise, particularly online as well. What are some elements that can impact the market and market trends from the Fed and/or from Washington, D.C.? Is there anything that the Fed or our friends here on Capitol Hill can or should do to try to clear the way for either better market transparency or to make it easier for people to have higher returns on their investments?
Well, there's no doubt that Washington has a huge impact on the markets. And you hit on it. These big swings. Markets are just, all they are information processors, relentlessly processing all known and unknown information. Everything factors into the buying and selling. And so when there's a big swing, as Ken Fisher has always said, that's a surprise. And usually the surprise enters from Washington. Suddenly something new comes from Washington that was unexpected. And that's why people like Ken Fisher are so big on buying when government is divided, because the odds, to your point, they're still talking infrastructure. They can't get anything done. Endlessly. And Ken would say that's a big positive, precisely because it's difficult to get things done. And so investors face fewer surprises.
In other words, they're too locked to screw around.
They're too locked to make big mistakes.
Yeah.
It's when they're getting along where you have to worry, because out of nowhere some really bad legislation could come through.
Right.
Now the Fed's kind of different. It's a known quantity inside the Fed, as an example, that the central bank has bailed out Citigroup 5 times in the last 30 years. It's not talked about, but inside the Fed, they know they've done it. Goldman Sachs wasn't just bailed out in 2008, it was bailed out in 1994. It's just these things come out. And so this is what the Fed can do, but to me, it's not a market booster. It's a source of market danger. Mm-hmm. The Fed can prop up, to some degree, financial firms, and it's done it before. And you think about the negative that is. We are an economy built on the relentless pushing of the past into the past. Ant Group in China right now, Lending Club in the U.S. right now, can lend faster and more accurately than the best banks in the United States. And they can do it literally within seconds because they're good on data. Yet we keep propping up these legacy banks because the view is, well, if we don't, there will be a financial crisis. No. The propping up of them is the crisis. I will go to my grave and I will keep proving it, that 2008 was a consequence of government intervention. It was never you can never get a crisis from businesses failing, but you can always get a crisis from the propping up of what the markets want to fail.
So your theory on what happened in '08 is really that people really mixed the cause and effect?
Unquestionably.
Interesting. Well, the other aspect of this that I find really interesting is how much accurate and guiding information about the market is out there that people are not paying attention to. So they really follow a lot of the superficial analysis on the media, and they're also kind of chasing the latest meme stocks on Wall Street Bets or whatever it is. But they don't take a look at actual data, actual earnings, actual stock chart fluctuations, and different stock chart patterns, which may be of a predictive element, which are not always correct, but may provide some indications there. In terms of what can impact trends in the market, I feel that one of the very undersold elements in our country is a lack of any requirement for media and market literacy. And what I mean by that is that, first of all, the lack of media literacy in the United States has created a lot of damage. I think it's created a lot of damage because people are not only aware of things that would make them more intelligent investors, but frankly has created a lot of division and destruction. And also, I don't understand why in our society today there isn't any requirement for more market literacy. I find it interesting that as we have our kids go through high school and college and any other training, that there's not a requirement as part of the core general education requirements for market literacy in the United States. And that, I think, is something that's really selling many people short, particularly are the younger generation. You and I have kids, and I try to pass on some market literacy and some ideas to my son. And because unless he takes an elective in college, He's not going to get it, but he will turn on the news, and he's going to find the next person who's going to say you can't fight the Fed. So, in conclusion, what are some things that I'd like to just conclude by talking about elements that can impact the market either in a positive or a negative way? What are some of the elements that are coming up where if we could make some kind of a change that we could avoid some of the or try to remove some of the negative elements or the obstacles that get in the way of people making smart decisions in what you believe, and I think accurately so, is really the market is the purest form of financial democracy. Companies' earnings, biotechs are going to be able to demonstrate their prowess once they get phase 3 FDA approval. There are certain clear benchmarks of success. Can you identify any other possible negatives that we can remove out of the market to help more people make more money?
Well, I would first say that while I like the idea of market literacy too, the challenge we always face is that the people who would teach it, if they really knew it, probably wouldn't be teaching it. Mm-hmm. And so you have that. And so I subscribe more to I mentioned him again, the Ken Fisher view, that markets will do your worrying for you for all the reasons you just said. They're the ultimate financial democracy. They will basically find out for you who's lying, who's doing better than was initially thought. They are always sniffing out problems before regulators get to them. And they also discover the high flyers before, in many instances, analysts get to them. So I like that. I like the idea of people just learning to save, that it's a good idea to be exposed to innovative people. The innovative people tend to have public companies. And so beyond that, I think probably the biggest threat, this is a bit out of left field, but I think it's very true. Who was it? Sir John Cowperthwaite, the head of Hong Kong, what was his rule? No economic statistics. And he was adamant about that. And he was, because the economic statistics are the playthings of interventionist politicians. As is, the Bureau of Labor Statistics spends $600 million a year and employs thousands of people to come up with an unemployment number that ADP comes up just as accurately with a few days before the BLS every month. And so you don't need these statistics from government. But what do? Why do people follow them? They follow them because, and investors follow them because they're trying to divine not what investors, they're pricing this the whole time. What will Washington do? And so there lies the danger.
If they're asking that from a fearful perspective.
Yeah, from a fearful perspective.
Yeah.
They're not, look, think about it. Consumer spending, consumer debt. You think that Visa has got better statistics on that than the typical government measure of it?
Right.
Well, the question answers itself. And so that information is always being priced. But what you have to always be fearful of is what will the government number be? And we have to fear what will Congress overreact? Will it panic? Will the Fed try to mess around with things? And so the fear is always, so if there's one other thing I would do, is I would just get rid of the economic statistics. They're expensive, they're bureaucratic, and they lead to more meddling.
Well, why not privatize these things? Can you imagine how much money we would save in the budget if we could privatize things that are already being measured in corporate America? You just identified a couple of them, and that's fascinating. And as I've said to you, as we've done these podcasts, you continue to bring things up that I think about it and I ask, why haven't those things been discussed before? If ADP has these numbers, or in terms of credit, if the lenders have these numbers, why can't we just let the marketplace provide that information? And if you're able to privatize a lot of this, then how much money would you actually be able to save from the federal budget every year? It's just such a fascinating point. Just to wrap this up, my concern about a looming negative metric that could really impact the market, and I really don't see it happening yet, but I think that following the upcoming midterm elections, as we're heading towards the 2024 presidential election, my concern is that there's going to be election chaos. And this is going to sound a little bit out of left field, but there are these maxims that may or may not be true, and one of the maxims of the market is, the market doesn't like chaos in Washington. Well, let's not forget that for about 3 hours on January 6th, the federal market, the federal government shut down. Came back, people came out of the basement, and they got on with the business of government. But if we have chaos that supplants democracy as we get into the next cycle of the presidential election, and if we're facing another insurrection, I feel pretty damn sure that a lack of democracy is going to be a distinctly and measurable negative factor on the market. And if folks are thinking that I'm overreacting or that I'm being a little bit too dramatic on that, I don't know if they saw and were watching what I saw on January 6th. So hopefully, as our government continues to move forward, they can get the job done in a way where we can avoid division and chaos and violence. John, great to see you. I'm glad that you landed safely, and we'll talk to you next time.